Hello and welcome to the Private Capital Podcast. I'm Joe Riley. We are hosting our first face-to-face event in New York on September 19th to bring family offices together. Steve Tannenbaum of Golden Tree is the keynote, and we will also have Zoe Cruz and a discussion between Torsten Slok of Apollo and Rebecca Patterson, one of my former podcast guests. It will be an excellent day of learning from the experts and each other. And if you are a family office and would like to attend, go to circulus.substack.com or click on the link in the show notes. Today's guest is Ted Seides from the Capital Allocators podcast. I first did a print interview with Ted exactly 7 years ago when he had just completed his first book, and at that point he had just started a podcast. Since then he has written 2 more books, Capital Allocators and today's Private Equity Deals, and now has one of the top investment podcasts in the world with over 400 episodes. Private Equity Deals is a set of engaging case studies derived from his podcast series and is an excellent and detailed read, delving deeply into 15 different deals. Ted Seides is the host of Capital Allocators, which includes podcasts, gatherings, and advisory. He was formerly co-founder of Protege Partners, which was a leading multi-billion-dollar hedge fund seeder, where he was president and co-CIO. Ted is also well known for his famous bet with Warren Buffett, a charitable wager pitting hedge funds against the S&P 500. Ted began his career under the tutelage of David Swensen at the Yale University Investment Office. Ted graduated with honors from Yale and received an MBA from Harvard Business School. I'm grateful to Ted for getting me into podcasting. He told me it was fun and easy and you get to talk to really interesting people, and he was absolutely right. Please enjoy my conversation with Ted Seides.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
Growing up, did you ever think that you were going to become an educator?
That's the first question.
That's the first question?
Probably. My mom was an educator. She was a preschool administrator teacher. My father was a doctor, but he taught his whole career. He taught PhD students and med school students. So
he was in psychology?
My father was a psychiatrist.
Yes.
Yeah. So I think there was a teaching gene, and I always thought I would teach. I didn't realize that this was a format for teaching when I started it, but it feels like there's an element of that, sure.
Well, Swensen wanted to become a teacher. I was surprised by that. I think you mentioned that.
Yeah, he was. He taught all along his entire time investing at Yale. He taught at undergrad and he taught at the School of Management.
I've noticed a lot of parallels between folks who took an early interest in baseball and baseball stats and becoming either good managers or good allocators. Do you think that baseball is a good analogy for understanding investment manager performance?
There are parallels, and for sure, when Michael Lewis wrote Moneyball, that was the first time I think the investment community realized, hey, there are these parallels, but how do you think differently about how things work compared to just what convention tells you how things work? And so people started, quote unquote, moneyballing different aspects of investing. And you saw that in manager performance. You saw people starting to think about disaggregating performance into, let's just say, market timing, sector selection, stock selection, and using data as it became available to try to tease out what is a manager particularly good at. So there's an element of that's true. I think the differences are, unlike baseball, which is a static container, and yes, the rules have changed a little bit in the last year, but for the most part, you understand the bounds of the game and it's in the same 90 feet from home to first base every single time you play. Markets are constantly changing. So I think it's less clear that all of that past data is necessarily as indicative as future performance. It's true of baseball too, as players age. So a hitter that has certain tendencies 5 years later and they're 5 years older may not be as good. So that deterioration curve is hard to measure. But for the most part, the container of baseball is a much more static container than markets. So there are parallels, but also there's some significant differences.
Do you think it helped you talking to managers?
It's funny you said it that way. I don't know if I've ever talked about this. My senior essay in college was a statistical analysis of baseball attendance. And I graduated Yale a couple years before Theo Epstein came out. So if I was just a little bit later on in my education, it's possible I would have gone the whole sports analytics route. I think it's less for me, it's less the interest in baseball and more that I always had a love of statistics. And that aspect, that quantitative aspect of analyzing manager performance, I imagine it could have been the same thing if I had become a stock picker and looking at companies, was just something I took to naturally. Math was never, still isn't work for me. That is just part of what was part of the fun part of the job.
You mentioned picking better managers in PE is vastly more profitable than equity or bond market managers. You said in the book the top 15 PE firms make 24% more than the median firm. Any advice on actually sorting those managers?
The data is what it is, right? That you can look at what markets are more and less efficient. And you do get to say venture capital first, and then private equity, and then hedge funds. People have gotten a lot more sophisticated in how they assess the quality of a manager. And that goes hand in hand with the availability of data. So if you look at some of the biggest players like a Hamilton Lane or a HarborVest that each have $150 billion invested in private markets and have for 20, 30 years, they have very rich data sets on what firms completed, what deals did they do, what was the purchase price, what was the exit price, what happened to the financials of the companies in the interim, just from their own investments, let alone all the presentations that have come their way and the data they've aggregated. So if you're looking at how are you trying to assess if someone is going to be good in the future, it sure helps to really be able to disaggregate what have they done well in the past. And you could think about that as purchase price, what part of the operational improvements did they have, how did they finance things, and how did they exit? And you start to have rich data sets to disaggregate that. I think people can come away with more insights than someone else who doesn't have access to those data sets, again, about what's happened in the past. And then you have to make some assumptions that there's some serial correlation in private markets, particularly private equity, of what happened in the past and what may happen in the future, or what types of deals worked for a firm in the past, and are there similar deals to what they're now doing in the future. So I do think there's an opportunity using data to be able to make incrementally better insights than another investor in private equity in particular.
So let's walk through your private equity education. I know you once said you learned what a stock was the day you learned what a hedge fund was. When did you first become aware of the concept of private equity, private investments?
Well, I'll tell a funny story. In my first couple of years at Yale, I don't remember exactly what it was, David and Dean and Tim Sullivan, who ran private equity, they were really good about sharing information and kind of teaching you things. And I was invited to attend an annual meeting in New York. I'm guessing I was 23 or 24. And it was the only time in my career where I overslept. And I missed the train from New Haven to New York. And I've forever wondered what I would have learned and what would have happened. I had plenty of other opportunities. It was pretty early on. There were 5 or 6 asset classes. You understood what all of them were. Tim was right down the hall. So it was all part of what was happening at Yale. I wasn't doing analytical work on private markets in my time there. I was much more focused on the public markets. But I knew I knew names of firms, and I knew who Yale had money with, and I could see performance. So in my 5 years there was a lot of osmosis in what was happening in the private equity world, adjacent to the time I had spent in the public markets.
I interviewed Scott Sperling, who was at HMC in the 80s, and he mentioned to me that David and Walter Cabot actually collaborated quite a bit on private investments, because at the time, where were you going to get deal flow? Did you guys do a lot of private investments at Yale?
There were no direct privates at all. So Yale's private market investments then, I imagine mostly still today, were all through managers. Harvard was more of a mix, particularly under Jack Meyer. They had a lot of internal management and people that later spun out, but they also had external manager relationships, and David and Jack were very close. There wasn't really a lot of communication in the diligence process when I worked at Yale with anyone on the outside. There were differences in the private markets from the public markets in that back then, when the GPs sent out their quarterly letters and financial statements, they had a list of who all the LPs were. And they had annual meetings. So you would see the other LPs at annual meetings. That aspect is a little more opaque today. And some people would collaborate on due diligence, but Yale really didn't. Yale did all of their work very independently from others.
What was the knowledge transfer process like at Yale. How are all these apprentices created? The kids were young. It was a small team. But when I talked to Casey Whalen, I got the sense that the information was passed on.
I think there are two aspects of that. One is the work, and the other was the mindset. So the work is easy to describe. There are a lot of manager meetings, and even as a young person, you'd be there. You mostly would keep quiet, but you'd be there alongside Tim or David and Dean, and they were really great at asking questions, and you'd come away with some insights based on what they thought. And then quarterly, all of the recommendations to the investment committee would get encapsulated in a book. And when I say a book, these were books. There were memos, each one 15, 20 pages long, and there might be 10 of them every single quarter, maybe more. So there was a 2 or 3 week period where we all furiously worked late at night and wrote, and David edited every memo. A recommendation of our manager had to encompass everything. So you would learn from doing that exercise, are you missing anything? And then you'd have everybody's opinions and you'd learn how to express that in a great way. And that I really learned to write from David, not in my education before that. So that's the work piece. The mindset was probably more important over time. And it's something that I learned to appreciate in my time after Yale, which is that Yale, like only probably a dozen or 2 dozen pools, is designed to have a perpetual time horizon. And something I like to say, perpetual is a really long time for long-term investing. Like forever is a long time. But most pools that in theory have really long time horizons, the time horizon is actually only as long as the individuals and their behavior that are in the seat. David wasn't that way. He really came into the office every day wearing the hat of someone who was investing for a really long time. His license plate was Endow, E-N-D-O-W, Connecticut license plate. And so some of the vernacular in the office, some of the way you talked about things, you really were able to, the culture embodied that really long time horizon. So nothing mattered any day. Markets go up, markets down, crash, rip-roaring bull markets. None of that matters if you're investing for a really long time. And you could feel that. There wasn't day-to-day furious activity. The cadence had to do more with what are we preparing for the investment committee next quarter, because there were preparations of that. And so there were aspects of that. David wrote his principles in pioneering portfolio management, and lots of people read it and then went to apply it. There's a difference between, can I write for you how to hit a 90-mile-an-hour fastball? That's very different from sitting in the batter's box and trying to do it. I could tell you all the mechanics of how do you move your hips and how quickly, what's the speed you have to start getting your wrist set. So working in that office for 5 years, it was the only thing I knew. It was my first job. And that's true of Casey and everybody else. You really were trained in this way of thinking about investing for a really long period of time. And that never goes away. And so I think those two things together allowed the group of people that came through to all understand what does it take to make a great investment, and how do you need to think over time so that you can really implement on that strategy.
And just to be clear, Swensen didn't think value in private equity came from the illiquidity, correct?
So I went back and looked at David's book in the last, about a year and a half, 2 years ago. I had a chance to reread it. And it's startling what compared to how people interpreted it. So to start with this concept of David liked illiquidity, I say nobody likes illiquidity. There are some features that people have come to understand that benefit investors about illiquidity, but that's mostly people getting out of their own way and not doing stupid things in the interim. But for the most part, you don't like illiquidity. David started with the first principle that for Yale's pool of capital, he wanted to be very equity oriented, and just investing in US stocks did not have a lot of diversification. US stocks are the most liquid equity instrument in the world. So by definition, if you're going to diversify your equity exposure away from US stocks, you have to have some level of illiquidity. So that's a bug, not a feature. Now, where illiquidity helped was if it was reflected in prices. Now, I wouldn't say because something's illiquid, it's therefore cheap. But if in fact the illiquidity came with a discount and you could accept the illiquidity, then you could get a premium. And back then, most people did not go near illiquid assets. And those assets were cheaper than more liquid assets. that goes back and forth sometimes today. Sometimes there is an illiquidity discount, sometimes there isn't. And David saw more where you started, which is that those private markets had an element of inefficiency because people weren't participating, that led better practitioners to do much better than worse practitioners. And he was willing to accept the illiquidity to take advantage of that. But he wasn't looking for illiquidity for the sake of illiquidity.
So let's talk about your podcast leading up to private equity deals. And I brought this along. I had this when we did our interview 7 years ago. At the time, that's the podcast you had done, the first 20.
20 episodes. Yeah, look at that.
And had some great names too. You had Andrew Golden, you had Duvos, you had Russo, Galbraith, obviously, the first one. And here's a quote from our 2017 interview. I thought it would be fun and interesting to have a reason to talk to all these people I usually talk to when I was in the seat. Let's see what happens. I could look at it and say, could this be a business? And the answer is probably not. It's media, I guess. Will I be any good at interviewing these people? I don't know. How do you reflect on this 7 years and 400 podcasts later?
I think that was all accurate at the time. And still is today to some extent. Yeah, I think I took that initial, I've used this joke and the joke's getting old, so maybe this will be the last time I use it, which is if I told you the business proposition was, hey, Joe, let's go have a conversation. And the business, we're going to match volume and price. And the price is going to be zero. We're going to give it away for free. But don't worry, we'll make it up in volume.
Right.
Like the old Saturday Night Live change bank. Right? So there was no reason to think there was a business. I was doing alongside of a bunch of other activities. And like a bunch of things happened. One is probably around that time, more and more people started listening for whatever reason. Now, some of that was this 20, and I say the first 50, we're all friends from the business, maybe the first 2 years. So having been in the business for 25 years at that point in time, we have a lot of great relationships. And frankly, a lot of that started with Yale. By being around that office, David had selected some of the best managers in the world. Some of them weren't known at all, remained unknown. Some of them became really well known, but I knew all of them. So I had these old relationships, and in my years at Protege, I had a lot of other relationships. So that was just really fun. And then you have this flywheel, which is as more people are listening, the guests have a better and better experience. And if it's a manager and you've got the whole allocator world listening, that's great. There's no better venue for them to tell their story. So it became this really fun activity where I'd be doing favors for people. Like they would come on the show and all these great things would happen for them. And eventually some advertisers called, and then I was like, wow, it is a media asset with some advertising. And then we figured out a couple other ways that made sense to bring people together in a fun way. But yeah, it's evolved a lot in those 7 years for sure.
What did you learn from your father that helps you in your interviews?
I would say two things. One is I was always interested in people and what makes people tick. So looking back, it's probably not a coincidence that I found my footing in selecting managers rather than securities, because it's the most people-focused and analytical, like people-analytical focused of investing. So that maybe that was genetic as opposed to learning it directly from him. But I always and continued both in self-discovery and in others and trying to understand what makes people tick. And the other, I'm not sure I would give him credit for it because I think it was as much learned over time as anything else, but just listening, the power of listening. Now, I'm a middle child, so I'm the opposite of a natural listener. People will say, wow, you listen really well. I don't think that was always the case. I always liked talking. I was a little chatterbox when I was in high school. But being in the seat of interviewing other people, you start very quickly to learn over time that if I'm going to do this every week, nobody should care what I have to say, because that's a very fixed amount of information and I'm just going to start repeating myself. So let me just take myself out of this and put the guests on the stage. So maybe some of that came from his career was listening, and he was a Freudian psychiatrist, so I'm not sure he ever really even said anything, just listened. But yeah, I'd give him credit for both of those.
Okay, podcasters should study Freud. So how did you pick the deals for the original Private Equity Deals podcast? What was the origins of that?
So the thought process initially was that among the investment markets, I didn't think private equity was covered very well in this format. And I guess that's natural, right? Podcasting is a new technology. And so probably it's not surprising that the whole venture world found the new technology and used it. And there's a lot of DIY public market investors. So you see a lot of public market stuff. But private equity, much like the world of allocators, it's a behind closed doors thing. So I had this kind of idea. And then much in the same way Capital Allocators got started, I first reached out to people I knew who were brand name private equity firms and said, hey, I'm going to do this. Any interest in participating? And I said to them, you can pick the company. And obviously there's going to be cherry picking and they all have lots of deals, so they're going to want to talk about the good ones. I said, but it has to be a current portfolio company or a very recent exit, like the last 6 months or a year. So at least you're narrowing the cherry picking to something that could evolve or was a recent exit. And so that's how it started. And I decided to do it in seasons rather than just a weekly, because you don't know when you're starting something if it'll get legs. So the first season they're all brand name firms. And then in the second season, I decided to do companies that people knew. So some of those firms are brand names, some are less well known, but every one of the deals is a company that people are familiar with. And then you start to think, boy, what could I do next? And I decided to do one on the mid-market because that is everything. The mid-market really dominates the world. And then you could do anything. So we did some of those. And then we stopped, started doing some more classic deals, one-off. And I'm not sure, after doing 20 of them, I said, okay, I get the joke. There's 24 different case studies, maybe it's 26 or 27 now. I'm not so sure this continues to be so exciting for people. It's a different way of looking at a company in an industry, but there are a lot of really great podcasts that do that. And so I don't want to say it's on ice, we keep going, but that was how it started.
And how did you pick the deals that you put in the book?
So it was almost exclusively from the first 2 seasons. And one of the things I found, not really by design, was that those 16 deals, almost all of them had something that was different. One of them was a great business that was handed from private equity firm to private equity firm. Maybe there were 2 or 3 like that. And some were in industries like software that have become really popular in private equity. And some were turnarounds and some were carve-outs. And if you put all these together, you would get a series of really interesting case studies of what actually happens in private equity, as opposed to a journalist who doesn't really know looking at one bad deal and saying the whole industry has gone wrong. So I put together a bunch of the deals that were in it that had these different characteristics, and I grouped them into 6 deals that were, call it at the market, sort of an auction type situation. Not all, but great, some type of good business where the private equity firm was just going to pay what the market was willing to bear. And then I did 6 that were clearly off-market deals, that for one reason or another, they were complex, they were orphans, they were something that nobody else wanted to buy, they were distressed. And then in a bunch of different industries. And so it's a nice little compilation of a small subset of what goes on in the industry.
This might seem like an odd question, but why do you think these stories are so interesting?
I don't think it's an odd question. I think it's a window into what private equity is. And everyone's broad. Private equity has gotten so large and is so important. We're talking about 10,000 companies, $6 or $7 trillion of market cap, and things we use, whether we realize it or not, every single day. And yet, in the public, the perception of private equity is mostly still really negative. I just don't think that makes a lot of sense. When you have something that's that huge, you can have everything. You're gonna have some really bad actors, and you have some really good actors, and everything in between. If you looked at the middle of all that, my guess is you'd be pretty impressed by what happens. And I just don't think that story is told. The other thing that's interesting about it is it encompasses everything. So you could look at stories of a whole bunch of different industries, a whole bunch of different ways of owning a business, and we're going to change management. We're going to keep management. We're going to keep the operations just as they are. We're going to completely change the operations. We're going to lever it. We're going to put no leverage on it. And so it's a microcosm of what happens in the economy. So it's less necessarily that any one story is so great, though a lot of them are really interesting. But you put it together and it's just a part of what's happening in the economy. I just don't think it's well represented in public.
These calls are very detailed, more so than a standard podcast. How do you prep for them?
It's actually not that hard. So I would do a prep call with the general partner, and I would walk them through, here's what let's go ahead and pick a deal, and we'll talk about what that is. I'd love if you could share some information with me about the deal. But for the most part, we're just going to talk about who are you, and what's the company, and why was it attractive, and what work did you do on it, and then what was that whole deal process? Like, how did you come to own it, which sometimes is really interesting. And then once you owned it, you had your game plan, what happened? And have you thought about exiting? So you're really just, the arc of the deal story is not that complicated. And then I was prepped by learning what I could about the business. But ultimately, I wasn't the one telling the story about the business. The private equity manager, the GP, is going to be doing that. So I don't have to be prepared to know. In fact, sometimes it's better if I'm not, because then I can ask questions that come into my head about something that might be particularly interesting about that business. So we're sitting in front of a bunch of Origin bottled waters that's owned by One Rock Capital, and it's one of the deals they had spun Nestle's North American business out of it. So it turned out that it's kind of interesting to think about, what is bottled water and where does it come from? And then is it a commodity, or how do you price it? None of that goes into prep. It's just, when I started talking to Scott Spielvogel about it, I said, oh, that's interesting. Like, how do you price this stuff? It's all the same thing, right? It was like, actually, no, it's not the same thing. Some of it is filtered municipal water. Some of it's from ground spring water. And they have different taste characteristics. You're like, okay, but I still think it's water. How do you price it? And so there are different aspects of what's interesting about the business that it's like anything else. I felt like it's an audience of one. I'm just having a conversation with Scott, and I'm finding these things interesting. I hope somebody else does too. So some of the prep isn't so much how much work can I do on that company. It's, you spent years and years thinking about different aspects of businesses and how businesses work. And then in different businesses, you go, oh, I'm curious about that. And you just let your curiosity take you.
I did an interview with Karen Knoop, who runs the case study department at HBS. And one of the first questions I asked her is, how do you get such detailed information from these companies? They're private companies. They went into Carlyle, they went into KKR. And what is the challenges of getting this information from private equity professionals?
I think it's real. And even on the different podcasts, you'll see when you get into the numbers, there's quite a range of what people are willing to share. So sometimes, particularly if a deal's been exited, or if they bought it from a public company and there have already been disclosures, they're more than happy to tell you it's already public. And other times, for competitive reasons, they don't want to tell you how much they paid or how much debt they put on it. There's always some public information. A lot of times, even though it's a private company, the debt is public. And through the disclosures of the debt, you can get information. But a lot of it is just asking. And people are willing to tell you what they're willing to tell you. If you don't ask the question, they probably won't share the information.
These are all fascinating deals. Is there a specific deal in the book that you found particularly illustrative?
There are a lot of fun and interesting ones. One of the stories I like to tell, and I think it's the second one in the book, is a business called Partstown that Berkshire and Boston bought. One of the reasons I like telling it is everything about it is the opposite of the public perception of private equity. So Berkshire is this firm that is just friendly. Like, they're known as everyone's collaborative partner. And it's true within this one of these places with no corner offices, and the partners have all been there for 20 or 30 years, and they all work together on every deal. And then when they buy companies, they almost never take out the management. I think 80% of their deals, the seller, whether it's another private equity firm or the owners, roll into the deal. Everything about it is collaborative. And Partstown is a business that makes small parts for like restaurants, all these tiny little parts that go into the restaurant business. And there's 100,000 different SKUs. And they bought it from Summit Partners, so another Boston-based private equity firm. They had worked with Summit and the management team on acquisitions with that company in the past. They had used their knowledge of the industry to realize that this was the best business that they wanted, that they could own in the industry. So you get that whole issue of the research that goes in, that all these private equity firms do to try and identify what type of companies they want to own. And then when they bought it, Summit rolled in, the management team rolled in. They've owned it for a long time. And I think the deal was back in 2016. And then they had their chapter. This company had just grown and grown. It had some issues during COVID, got their way through it. They decided they didn't want to sell the business, so they did a continuation fund. So they still own the business, and their next fund owns the business, and they brought in another private equity firm. And it's just everything about it is the opposite of corporate raiders, slash and burn, cut jobs, strip of cash flow. So it's a fun story, just that's such a different perspective from what you might read about in the public about private equity. And so those characteristics make it a really fun one for me.
I think that's one of the things that was so interesting about the book is it reminded me of how much actual work goes into these things and how your initial strategy, of course, immediately evaporates once you actually engage with the company. And so a lot of it comes down to the determination of the individual. So I would ask you, who's good at PE? What patterns do you see emerge as you look through these cases?
Well, one of the things that's harder to look through is, boy, they all seem really good. Now, there's a select group of firms, right? The firms that are represented in the book are not all the private equity firms, and I suspect every single one of them was top, whatever, core top. It's an interesting question to ask of what does it take to be successful in the business? Private equity firms have a bunch of different levers to drive value, right? One is the purchase price. And historically, we've seen multiple expansion. That might not continue. One is the ability to understand how to finance operations and to be very flexible with that. In a higher interest rate environment, that's going to be much tougher than it's been the last 20 years. So I think the most important driver going forward, and you certainly see that, if not in every case, almost every case in the book, are the ability to improve the operations of the business. And that comes from a combination of the outside view, so their ability to do research across industries and understand what are the best margins, let's say. How did another competitor achieve those margins? How can we go about doing that in this business? As private equity's gotten larger and larger, they can bring higher and higher quality resources into the business. So when I worked at Yale, there were only places like Clayton and Dubilier that had operating partners. It was like a novel model. And now almost every firm of size has an army of seasoned operators that they can put into a business. And it's almost just part of the playbook that you can bring in a seasoned executive and help. Maybe that person's going to help in sales and marketing. Maybe they're going to help in operational efficiency. Going forward, in a higher rate environment with prices already elevated, you can't expect you're going to be able to drive value just from financial engineering or from price. So those that have demonstrated the ability to improve operations and take a business that wasn't doing as well, make it better, and it's probably worth a little bit more on price and sell it, I think those are the ones that are going to be the most successful going forward.
You list a number of pre-publication readers of the book. What feedback have you received from industry professionals after they've read the book?
It's been positively stunning, I would say, because when I thought about putting the book together, I said, this is like a nice compilation for outsiders. For the people who don't really understand the industry. Anyone who's an LP investing in private equity firms has these types of detailed conversations with their managers and those trying to raise capital. And yet, I shared it with a bunch of high quality GPs and LPs, hoping to get some endorsements for the book. And they were generous and got some great quotes. What surprised me the most is someone like David Rubenstein saying, I thought I'd been around this business for a long time and I really learned a lot, was not something I was expecting. And it does come from, at times, any one of the practitioners is so deep in what they do that they're certainly in other deals with other GPs, but they don't always get the full story of other people's deals. So that was fun and rewarding to have a bunch of people saying, a bunch of people from inside the industry saying, this is the book I would want to share with people to explain how the industry works. That was the reason I put it together, and I felt very gratified that other people have felt that so far.
How would you teach these lessons if you had to turn this book into a course?
I'm certainly not the person to do that. The nice thing about the book is the people teaching the lessons are the ones who are in the room. It is the GPs who are the stars of the story. And so to have them walk through in each case how they go about it, and it's all a little bit different, I think there are different lessons for each one. If you were teaching how private equity works, you could probably only do it at a high level and try to understand, as you walk through the investment process, how do people go about sourcing deals? What does their due diligence process look like? How do you win a deal? What are the levers you'll pull once you own it? And then how do you take it from there and thinking about an exit? That's like a high level academic approach, but where the real magic happens is on the people side of the business. How do you make these things work? It's a lot easier to describe than it is to do.
So let's go back and think about, you're learning about the world of private equity and where we are today. What do you think about the evolution of the industry? We've got these giant firms now that have grown up. Do you have a sense of how these firms not only maintain an edge as an institution, but maybe the future of where this is going?
I would start by saying it's not going anywhere. Sometimes you have people at extremes saying, oh, this is the tipping point, rates are going up and it's all going to collapse. There's zero chance that will happen. So private equity is going to be around for a long time. One of the things you find over the years is that these firms, both within the businesses they buy and their own business, they're very creative and they're very adaptive in an effort to drive value for their investors. So what does that mean today? There are liquidity challenges. There's a whole bunch of reasons why over the last couple of years, a little bit from higher rates, a little bit from public markets being closed, right? Exit strategies are either going to go to the public markets or a strategic or another sponsor. That's the way deals get done. The IPO market hasn't been very receptive and companies don't really love being public. Strategics for a while have been nervous about the economy and have a harder time swallowing bigger and bigger businesses. And so you're left with, okay, I guess there's sponsor to sponsor transactions, but rates are higher, businesses might not be worth as much. Maybe people want to hold them for a couple of years longer, but the businesses grow into the valuation. So you've had this bottleneck, and the response to that have been new innovations, and we'll see what happens with continuation funds, certainly a burgeoning and growing secondary market, even some things like NAV loans, which I don't think will be the answer to try to solve those problems. So if you look at the industry as a whole, it's huge.
Well, how would you think of it? Here's a better question. How would you think of it as from the LP seat? Obviously, all the LPs I talk to, they're all hyper-focused on DPI. And I would think, and of course I went back and looked at Swensen's book, I would think that David would be like, what are you so short-term focused for? These are private equity funds. This is going to take a long time.
Yeah. So there's a whole bunch of cyclical dynamics. Like, first answer is kind of secularly, I think private equity is going to be fine. And it's going to reward people for a long time. Cyclically, there's some challenges, for sure. The first is liquidity, and depending on how people have modeled their investment pace in the past and where their allocation sits today, determines whether they have to adjust that going forward. If you look at the industry at large, there's already a lot of money there, so it's a significant percentage of an entire pie of asset allocation. And other from probably certain sovereign wealth funds and maybe the mass affluent in private wealth, you're not seeing significant inflows to private markets. And if anything, you're going to see effectively outflows as the wave of distribution starts to come. Most of that money first will go back to the public markets to rebalance before it'll get recycled within the private markets. LPs looking out, it's anything else. You have to look at what price are you paying? What do you think the private equity firm can do in terms of improving the operations and where are they going to be able to sell? And that's where you're going to drive your return. It's hard to put that math together and see that you're going to be able to have the same kind of returns that you have for the last 20 years in a very favorable interest rate environment for the next 5 or 10. And people should be aware of that. The question then becomes, what do you do about it? And what are your other alternatives? If the private markets aren't delivering as high returns, does that mean the public markets are? Probably not either. So generally speaking, as you're preparing for a different type of environment, you just have to be thinking about both sides of your balance sheet. What does that mean for spending? What does it mean for the returns you're going to be able to generate? And then pick your pockets, because as we started with, there's a pretty wide range of potential returns that you get from the activity of private equity. So being with the right general partners will make a huge difference. If that entire range comes down, there's still going to be a wide range. So people can still get what they need to achieve in terms of their returns for the risk that they're taking in private equity. But it might be that fewer of the private equity managers will get them there.
What advice would you give to family offices who are doing PE in-house?
Be aware of what the competitive landscape is like. So a lot of people would like to do PE in-house because fees are high, and they certainly are. And it's doable, right? There are definitely professionals that somebody could hire that have experience in doing deals. The most important thing is to have the right resources, not just to be able to find a deal, but to be able to drive value. And if you take it to an extreme, I don't know that a family office is going to be competing with a Blackstone or Apollo or a TPG, but the resources that they have available, both to understand where you should be looking, to source the transactions, to get a deal done, to drive value, are nothing that any modest-sized family office will ever be able to do. Is that worth the 20%, the 2 and 20 that you might be paying them? That's up to someone to decide. But most of the time when I've seen individuals wanting to get involved in deals, it's not that they can't do it and do a good job. It's just that the odds of their success are much, much lower than a reasonably good or high quality private equity firm.
What do you think about the prospect of PE investing in the NFL?
I have no inside information. I think it's happening. My guess is in the next couple of months, probably by the end of the year, you're going to see the NFL adopting rule changes to allow minority ownership. I think I'm close to the guys at Protege Partners, and they're certainly one of the half a dozen firms that are been researching it and working with the NFL to try to figure out, if and when that might happen. And I think it's probably more likely than not that we're going to see that over the next couple of months.
But do you think, based on what you've learned from Markdos and from your interviews, that it will change the landscape of the sport?
Not at all. I think on the margin, the benefit of bringing in minority capital is the values of these teams and assets have gotten so large that when there are projects that require capital, and you think of that sort of holistically as the business, not just the team, but say a real estate project next to the team or a minor league system or something like that, it's just gotten harder and harder for the individual billionaire who's plunking a couple $1 billion down, $6 billion, Josh Harris, David Blitzer, to buy the Commanders. Are they going to want to put another $1 billion in to do a real estate project adjacent to the stadium? So I think at this point in time, the scale of the value of these assets is so large that they need growth capital. And a significant part of the minority ownership that's coming in is providing that. And so I think net, I think it's going to be really good for the league.
What do you think of all these various Swensen Cubs, so to speak, many of whom you know, and how they've taken the Yale toolbox and applied it to all of these very different endowments?
Yeah, we'll see how this continues. For a long time, David had a philosophy, a process, and a roster of managers. And most of the world didn't know who those managers were. So when Andy went to Duke and then Princeton back in 1993-94, one of the things he would do is the managers he knew by and large were the ones that Yale had. Same thing with Seth at MIT in 2005 and so on. What you have is a philosophy and a process for how to think about investing and a group of managers that have been very successful, some of whom are known and some of whom are less well known. And so my sense is, at least in the past, you're going back 20 years or more, most of the people, because when you worked at Yale, you didn't know anybody else. So you would start with some subset of that roster of managers that would be willing to take your money, and then you would go from there. And it's one of the reasons why, if you look at the longer term returns of, say, the endowments and foundations, with great consistency, most of the people that have worked at Yale find their way near the top of those ranks. And then the question is, what happens from there? And you have seen the individuals put their mark on how they go about it. So take Seth Alexander at MIT. Seth first got to MIT, he was 31 years old, same age David was when he got to Yale. And it was clear that they had hired him because they wanted him to be David. But he's not David, and he knew he wasn't David. In his first 2 or 3 years, he's, they want me to be David, but I'm not David. Seth is brilliant, humble, and a real team player. And over the years, he built a culture at MIT that is much flatter than the way Yale's office ran, which was mostly David and Dean making decisions and other people supporting those decisions. MIT's much flatter. It took the shape of Seth's personality and image. Now, there are aspects of the investment approach that are identical. The types of managers they like to find, looking earlier than other people, being able to strike more aligned deals with managers than if you were just the next investor in a fund. But yeah, each person that came out probably started with a map that David handed them, and then they had to put the map on their territory. And some of that is similar and some of it's very different.
And what about someone like Andrew Golden, now that we've seen the whole arc of his career as well?
I think when Andy started at Princeton, there really wasn't. It was really early days. I was still at Yale back then. And so part of that was probably more similar than different. He's just retired after 30 years. And yeah, he evolved it. I think the biggest difference I would say that I saw in what Andy did at Princeton and what David did at Yale was decision-making process. That David made the decisions at Yale, period. There weren't that many to make. He made the decisions. There are other people that have some input, but for the most part, he made decisions. When you look at the evolution of, to call it decision-making theory, how do you get all the information from all the people involved? How do you bring it up so that you can map out all the potential outcomes that you could think about? Andy did a phenomenal job of that. And he used all of the science to have all the people on his team involved in informing decisions to make the best decisions they could. I'm sure there are lots of other ways he evolved. I didn't work with him at Princeton, so I wasn't inside to really know some of the more subtle things that they did.
So I'm going to ask one of the few people who know the answer to this question. What is the difference between David Swensen and Warren Buffett?
So a lot of similarities and a lot of differences.
What are the similarities?
Well, the similarities are they're both very independent thinkers with strong convictions in their own views. They both have had, in David's case, a very pristine way of being able to simply describe investing from first principles. Warren has all these phrases that people repeat. David did too, but it was just behind closed doors. They both are mostly sole decision makers. So there's a real gift that they demonstrated by being great in what they did. How they went about the investment challenge is totally different, right? There are similarities in trying to back great people, but Warren was buying businesses and David was investing in investment strategies. So totally different. I would say among the many people I've met, they are two in very rare company that oozed wisdom with everything they said. Doesn't matter if it's about business or personal life, or they both were just remarkable fountains of wisdom, and you would want to cling to absolutely everything they said.
And the differences?
There's certainly differences in the investment approach. There's a huge difference in the public profile. David, for the most part, was completely out of the public. He wrote a few books and he would talk a little bit, but Warren is a public figure in a way David never was.
Do you think that's a good or a bad thing for a manager?
It can be both. One of the things I learned in my time after leaving Yale, because David had such a pristine way of thinking about what works for an investment manager, is that the success of an investment manager is tied to the success of their business. And that sounds obvious, but at Yale, all you really cared about was the investment strategy, and if Yale was the only client, David was very happy with that. When you get out into the rest of the world, you realize that an investment firm can only have long-term outperformance if they're around for the long term. And there's a lot of implications of that. What does that mean about growth? Is growth a good thing or a bad thing? Well, it can be both. Is staying focused on one little strategy a good thing or a bad thing? It can be both. I think that when it comes to being in the public, there can be a benefit to a business in building your brand. It's become increasingly important in the alternative space, whereas when I worked at Yale, none of those people were in public ever. And David loved it that way. He wanted to be all of their capital and didn't want anyone to know about them. But if you don't have confidence from your investors, that could be a problem in an inevitable period of underperformance. And so that's what a brand is all about. And sometimes being in public is the way to curate your brand. Now, being in public can be a blessing and a curse. And if things don't go well when you're in public, that doesn't help you at all with the brand. So I think it's more what matters to an investment firm is the quality of the brand more than are they doing that in public or doing that in private. But increasingly, there is a public component to that.
An important part of your last book was active versus passive strategies. What's your evolving thinking on that?
So I've always had a little bit of a contrary view about active strategies, which is that most of the people look at active versus passive and say, do active managers, say public markets, keep it simple, do active managers outperform passive? And if they don't, they have no reason to exist. I look at it the other way around. I say passive should have to outperform active, because if you're invested in an active manager, you have a relationship with that person, and relationships create options, and options have value. So I would rather invest in an active manager net of fees that match the market than buy the index fund, because if I have a relationship with that manager, they might introduce me to another investment opportunity. They might introduce me to another manager. They might tell me something that enhances my life. I don't know how to quantify that. But I'm a big believer in active management, which is a separate question from will active managers outperform the S&P 500? When you get into private equity, there's no passive alternative, and there never will be. So if you're going to invest in private equity, you're going to invest in venture capital, those are active strategies, period. To some extent, real estate's a little bit of both. Public markets, different question. And that's really when people talk about active or passive, that's what they should be focusing on. Much harder to outperform in the US. It's gotten increasingly hard over the years. And it's also been true in developed markets and emerging markets. But I've long been a believer in the power of relationships, and I think that's part of what you get when you invest in active managers.
What's next for you?
Right now, it's more of the same. I'm having a tremendous amount of fun. We'll keep cranking on the podcast. We've started doing some boutique gatherings, we call them summits, Capital Allocators summits around it, bringing together really high quality LPs and GPs in a different way than typically happens. So we don't do it with speeches or panels or presentations or one-on-one pitches. It's really people getting to connect and learn from each other.
So what, it's just an unstructured kind of weekend, or is it
It's a combination of some structured small group discussions and a fair amount of unstructured time.
So you have facilitators and et cetera. Yep. Okay.
And I'm doing a little bit of advisory work with my partner, Rahul Mudgal, with some managers that's come out of the summits, is people asking us for some help. And the nice thing about doing the podcast is ideas come in all the time. There's this great optionality that comes from doing it. So I don't really know what direction all this will go, say, next year, but it's really exciting being able to come in every day and have people throw things, hey, have you thought about this, you thought about that, because the brain power is never just confined to one person. So I don't know exactly where this will all take me, but it's already come a lot further than I would have thought, and it's just an incredible amount of fun.
Ted Seides, thank you for joining us, and thank you for your excellent insights, and thank you for introducing me to the joys of podcasting.
Joe Riley, it is a great pleasure to have done this with you and to have been a friend for so long.
Thank you. Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.